Welcome back, everyone. Today we're going to take a look at ASAN again. Super boring company. It's sleepy. It's done nothing since 2022. The stock has been down from a peak of $141 from 2021, down about 90%. This is going to catch everyone off guard. It's only a $3 billion company. The stock market rally happening right now is driven by a small group of stocks, a concentrated group of large cap stocks, and everyone thinks the smaller company, the ones with fewer resources, are likely to be long-term losers in this AI race. But I think they're wrong. So if you live under a rock, Asana is a work management platform. Basically, they have an AI that collaborates with humans that brings together all the different projects in a team into one organized application. No more emails. And they also have AI features that are rolling out slowly. But right now, there's just so much pessimism happening with this stock, especially after the founder, CEO Dustin Moskovich, has left the CEO role, but he is still currently sitting on the board of directors. With shares of Asana down more than 27% year to date, I feel like this company is at an inflection point, and this company does present a compelling value alternative in an otherwise expensive market that we're currently in right now. All right, let's go ahead and get started. First off, check out the institutional ownership, sitting at an all-time high. So institutions are buying, but the stock price is down. Insiders also own over 60% of the company. The stock price is also sitting at an all-time low because it's highly shorted. The short float currently sitting at 17%. And lastly, when you go to the income statement, the company is still not making any profits, but their cash flow has been improving, and we'll go over that once we take a look at the fundamentals. Multiple downgrades on this stock. You have HSBC Securities, Morgan Stanley, both downgrading the stock this summer. But remember, guys, one of the biggest catalysts is Dustin Moskovich has been buying this stock for the past 3 years. He is the single biggest owner of this company. He is one of the co-founders of Facebook. He's worth $11.8 billion. He could fund this whole company himself. Currently, it says he has over 57 million shares. 57 million shares of Asana, while it's saying total share count is over 230 million. He owns about a fifth of the company. But again, the company is hitting an inflection point. We're going to pull up the fundamentals right now. Check this out, guys. 8 consecutive quarters of total revenue growth and 8 consecutive quarters of earnings per share growth. Yes, they're not growing as fast compared to other tech companies and other software companies, but they're still growing. Latest one, they posted 196 million. That is up 9%. Check out these profit margins, 89%. This company is a money machine. For every dollar the company makes, they keep 90% of it. And go down to the free cash flow. With positive free cash flow, currently sitting at 3 consecutive quarters of positive cash flow growth. They have accelerating AI adoption, and they have a clear pathway to profitability. I think this company can make you some money, guys. It's sitting at an all-time low. But check this out. Free cash flow per share, cash flow from operations. Compared to 2 years ago, 3 consecutive quarters of positive free cash flow. No one is paying attention to how the improvements in their free cash flow and free cash flow per share are showing up. I mean, let's just look at the yearly. Just look at this improvement right here. So 2023, negative 160 million on cash flow from operations. And 3 years later, they're posting positive 47 million. The cash flow from operations is up almost triple what they were producing in January of 2025. So 2023 until today, the stock has still done nothing. But the fundamentals, guys, the fundamentals are starting to improve, but the stock price hasn't improved. So that's what you want to look for. You want to look for where the fundamentals are improving in a company, but the stock price has stayed flat or has done nothing. That's where you're going to get some of these outsized returns. But as of right now, this is the most important thing right here. Free cash flow per share and cash flow from operations. Why? Because it's a critical milestone for Asana in the company's evolution towards sustained profitability, and also with this high gross margins that they're producing, it allows them to have significant operating leverage as they grow, meaning the cash flow that they're receiving will exponentially grow in the long run. All right, let's just talk about this for a little bit. The era of collaborative AI teammates is here. So this is the newest thing they released. It's called AI teammates. Basically, they are AI agents that are going to be able to work for you. They're going to take on complex tasks. This is where technology is heading. You want to invest where the puck is going, and right now, this might be one of the most undervalued AI companies out there. The competitive advantage that Asana has is they have proprietary data. And we're living in a time where proprietary data is one of the biggest competitive advantages that a tech company can hold. And what they have is called the Work Graph. Asana is more than just a work management platform. It's a comprehensive organizational intelligence platform that becomes more valuable as they capture more data. But this proprietary data set that Asana has and the no-code accessibility that they could deploy with these AI agents creates a giant defensible moat for Asana in the increasingly competitive work management space. Lastly, remember guys, Asana is a software company. They have some of the highest switching costs in the SaaS industry. I mean, think about it. Once a company connects all their data into Asana, once the employees, once the executives, once upper management all learns how to use Asana, it's going to be hard to get out. Organizations that are using Asana are going to be so embedded into the platform that it's going to be more expensive for them to leave. So they have two competitive advantages: high switching costs and also proprietary data. The more large organizations that Asana can capture, the better it is for this company. And that is what they're working towards. If you take a look at customers spending $100,000 or more, this is what they're focusing on. They're growing the large enterprise customer faster than they're growing the smaller customers. The average growth of the large enterprise that they are capturing is 20% year over year versus 10% on the smaller customers. So this segment right here, customers spending $100,000 or more, that now represents approximately 80% of new growth. So they talk about how the shift toward enterprise customers provides higher lifetime value, better retention, and greater expansion opportunities. So again, the stock is trading at a 52-week low of $14, only a $3 billion valuation. Guys, they have 3 consecutive quarters now of positive cash flow growth. They have improving fundamentals. You have a CEO that is nonstop buying the stock back. You have proprietary data for competitive advantage, networking effects, and also high switching costs. Institutional ownership is quietly going up. So if you stayed to watch this whole video, thanks for watching. If you're new to the channel, don't forget to like, subscribe. But as of right now, let me know what you guys think about Asana. Not financial advice, but I think this is one of the most undervalued companies out there. Anyways, thanks for watching, guys, and I'll see you on the next video.